Hello investors, this is Kritesh from TradeBrains and today I'm here with the book review of one of the most famous book on investing, The Intelligent Investor by Benjamin Graham. So if you are going to read this book, I'm warning you, this is a big commitment because the book is around 600 pages. The book was originally written in 1949, but I read the revised edition which has an added commentary by Jason Zweig. Now let me give you a brief introduction about Benjamin Graham. Benjamin Graham was a very successful investor of his time and also known as the father of value investing. He was the mentor of Mr. Warren Buffett during his college days in Columbia University. There's something written on the top of the book. By far the best book on investing ever written, Warren Buffett. Warren Buffett, one of the most successful investor of this time and certainly one of the richest one also, thinks that this is the best book ever written on investing. Also, there is a preface written by him in this book where he gives a brief review about the book and suggests you to pay special attention to chapter 8 and 20. Now, if one of the most richest person on this planet is saying you to read this book, then you should certainly read it. There are many important concepts that are discussed in this book, but the three most important that I liked or learned, I'm going to discuss about those three today. The first one is speculating versus investing. This is discussed in the chapter 1. Here Mr. Benjamin Graham suggests that an intelligent investor is the one who, upon proper analysis, has some principle of safety and gets satisfactory returns from his investment. And the speculations are one who doesn't follow this. This means if you don't do the analysis, you don't have a principle of safety, and if you're not getting satisfactory results, then you are just speculating. The next important principle that I learned from this book is about the margin of safety. This is described in chapter 20, and Mr. Graham suggests you to always have a margin of safety during your investment. For example, let's say that you are a construction engineer and you are given a project to make a bridge of 8 tons. Now, considering that you are a good construction engineer, you will make a bridge that can take a load up to 10 tons, taking some safety because you know how truck drivers drive in India. They will surely overload the truck. So there's no harm in adding 2 additional trucks that can hold, so that the bridge won't collapse in such cases where the trucks are overloaded. In the same way, Mr. Graham suggests that you should always have a margin of safety in your investment. If after analysis you think that a stock should be priced at rupees 100 fairly and squarely, then there's no harm giving some benefit of doubt to yourself and buying the stock at rupees 70 or 80. You might have done some wrong in the calculation, so it will be good if you give some safety to yourself and take this rupees 20 or 30 difference before buying the investment. Our third important concept that is given in this book is from the chapter 8 about Mr. Market. Mr. Market is a fictional character and he is taken as a business partner of yours. So every day he comes at your doorsteps and offers you 2 things. First, he is ready to sell his stake of the business to you, or second, he is ready to buy your stake of business. But the catch is that Mr. Market is very emotional. Sometimes he is very happy and very greedy. Then he comes and he is ready to sell his stake at a very high price, and surely he is also ready to buy your stock at a very high price. And the other time he is very sad and depressed and asks you to buy his stock at a very low price, or is ready to buy your stake of share at very low price. Now Mr. Graham suggests that an intelligent investor is one who takes advantage of the market, that he doesn't get influenced by emotions and always take controls of his emotions and always invest intelligently. That is, he will always buy the stocks when they are cheap and he will sell the stocks when they are high or they are expensive. This is the third key concept that in this book, and this is certainly applicable in today's world also. You can find a number of overvalued and undervalued stock in today's time, and you certainly need to buy low and sell high. This is the concept of Mr. Market. So these are the 3 important concepts that I learned from this book. First was investing versus speculation, second was margin of safety, and third was Mr. Market. Overall, this is a definite book to read, and I will definitely suggest you to read this book. I myself has read this book 2 times, and I think I'll be reading this third time also because there are many concepts that I am still missing. Now, if you want to read this book, grab a copy on the Amazon. I will definitely not recommend you to read on ebook or Kindle or PDF because the book is around 613 pages, and you're not going to spend to read 613 pages on your mobile, are you? No. So check out this book, and I hope you like this video. If you have any doubts, write down below in the comment area and give a big thumbs up if you like this video. Also subscribe to my channel. I publish new videos on investing. This is Kritesh signing off.